Good morning, everybody. Welcome to the Flow Show. Another week kicking off. Should be more fun and games. Not joined by Kay today, as he's still with his family. Stelios as well is out and about, so it's just me.
No. I'm here on this one.
Yeah.
I'm out afterwards.
Oh, you're out. I thought he was going to miss.
Are you disappointed?
Mate, I don't like to do this on my own. I like my friends around me.
Good.
Yeah, good weekend, mate.
Yeah, not bad actually. Thank you very much. Oh,
Good.
I hear an echo. Good. Where is that from?
An echo? Not me. Is it me?
Well, it's only me and you with the microphones. Anyway.
You on a toilet or something in the bathroom?
No. It's not there anymore. Okay, good. How was your weekend?
Yeah, I had a big long trip up to London for the football. Trains all up the spout, so that was fun. Had to get a 7:45 train in the Saturday morning, and we got home about 9:30 at night.
Oh, wow.
So long old day, but yeah, we got 3 points. So back in business.
That's very good. Very, very good. I think Arsenal have a good chance this year. I think.
Yeah, they're doing that thing where they keep winning. You know, when a team just keeps winning, no matter what happens, they get the luck. They get the breaks, and it's all going the right way for them. Unfortunately.
Well, that's how to do it. You win more than others. That's how you win championships.
Yeah. We were trying the opposite of that, trying to lose as many as we could get on the trot.
Yeah.
So yeah, it's going to be a good run in. Hope they don't win it, obviously, but we shall see. We shall see.
It's been a quiet day so far, right?
Yeah, well, sort of quiet. There's been a few bits and pieces going on. We haven't got much data out today or anything like that, but
no.
Yeah, a few moves going on overnight, which we'll take a look at, obviously, in a moment. We'll crack on with the headlines and comings and goings, and see what we make of all those. Right, starting in Japan, and last week Kuroda said that he expects wages to accelerate growth, and that will eventually help us meet the 2% inflation target in a stable manner. The economy can grow 1 to 2% in the next 2 years. That's boom times in Japanese terms, and that inflation was largely caused by the import tax hike. Japan's Kishida, the PM, said that he will nominate his new BOJ head next month. We've had this on-off, will it happen in February, stuff going on last week or so. He had indicated he may leave it till March, early April before he makes a decision, but he said he's likely to nominate a new head next month. So we'll keep an eye on that one. He also said that labour market reform is needed for pay rises, and that the government will unveil a template for jobs-based pay by June. So that's something that's going to come in the pipe. And now on the BOJ, we had their minutes out, and the overriding headline was that they won't hesitate to add easing if necessary. However, one of the members said that we must ensure market players are prepared against risk associated with a rate hike when the time for ending the easy policy comes. There was also a bit of a headline drop in this as well, that during the meeting, when they announced, obviously, the change to YCC, that they had to pause the meeting to allow government officials to get out and pass on that message sort of in-house, because the government members are at the Bank of Japan meetings, and in fact Finance Minister Suzuki said that the December BOJ meeting was reported to the MOF before the announcement, but it seems that wasn't to the whole of the government, so they had to pause the meeting, have a little break while government officials went scurrying around, passing on the news and doing whatever they needed to do. Now, since then, Suzuki has also warned of severe financial issues as the Bank of Japan struggles to contain yields. So it has been becoming a bit of a problem, the pushing yields to the government. this all falls into something we've been saying for quite a while regarding the Bank of Japan tightening up and perhaps going to hikes, is the impact it's going to have on government borrowing and their obligations, future funding, as well as all these fiscal measures that they're rolling off. So that potentially highlights the problems that the Bank of Japan faces if and when they finally do decide to start exiting their monetary policy. There's a lot of people who think it's all going to happen really quickly. As we've been saying, I don't think that's going to be the case. It's going to have to be a very, very slow, drip-fed way out of easing because of the financial considerations they have to make. So that's all going to play into what we see over the few months coming. We see what the Bank of Japan do and what the government do and what wages do and who the new governor is. So lots of stuff stacking up there. Over to the Riksbanks, and Riksbank's Bremen said inflation needs to become low and stable again. The policy rate may need to be raised further, and we are not happy with the weakness of the crown. We think that rates will stay at a high level for longer than the current market forecast. So one there for all your Sweden traders.
Stocky, the stocky.
Yep. Yep. The SEK. ECB's Lagarde says that the ECB will do what is necessary, trying to channel her inner Draghi there last week. That was at the Davos stuff, following up the strong rhetoric we've heard from other ECB members following the story that they may not go they may not go as many 50s on the trot as they said. She hopes, and we know what hope is, it's never a trading strategy, hopes that fiscal policy doesn't force the ECB to do more. So she wants governments to play their part as always. ECB's Holtzman said he expects multiple rate hikes of 50 BPs at least in the first half of 2023 and is reluctant to say inflation has peaked because core inflation has not. ECB's not was out quite strongly over the weekend, saying that the ECB are not giving up on 50 basis point hikes. So going strong again there. We've got the banker calendar this week on Wednesday, and a Reuters poll of economists expect them to raise once more by 25 BPs at this meeting. That'll take them to 4.5%. 26 of 29 say that they're going to hike by 25 BPs. I've checked the BOC probabilities this morning, and a 25 pip hike is a 72.7% chance, and keeping rates unchanged is the balance at 27.3%.
The BOC just follows the Fed, right? I mean, mostly. So it looks like the Fed's going to be doing 25. They're going to be doing 25. So anyway, yeah, let's see. We have to remember they were one of the very first to turn hawkish. So,
I was going to say they actually led the Fed by hiking before the Fed up when this hike cycle started.
Yes.
They need to pay attention to what the Fed does as well.
Yeah.
They are also going to start issuing their monetary policy meetings from this week's meeting as well. So that was something that they touted last year, and it's starting for this meeting here. To help them along a bit, we had Canadian retail sales out last week. Not much to draw for them really. Month to month, they fell 0.1% versus 0.5% expected. Previously, they were up 1.3%. Strip out autos and they fell 0.6%, which was round about expectations. And the price was up 1.6%. Now, these were November readings because they are quite some way behind on the data sometimes in Canada. So that was November. We'll see what December brings, but that'll be too late for this Wednesday's meeting. Over to the good old US of A, and Fed George says the US economy is responding to Fed's actions. You might call a bluff on that one. Says it is encouraging to see inflation coming down, and that they must be a little more patient in assessing if inflation is on a sustainable path down. Now, Fed's Waller was also speaking, and he's on the board of governors, so he's like a permanent voter. And he favours a 25 pip hike at the next FOMC, the upcoming FOMC, and continued policy tightening beyond that. He says progress has been made, but still a considerable way to go towards a 2% target. And by early December, the Fed's policy stance was slightly restrictive, but now is a time to slow but not halt rate hikes. And the market perception of terminal rate is not far from where we are. And just to take a look at that, I've had a look at the the shorter term US bonds, the 1 year government bond yield. We've been looking at the 2 year yield to give us a bit more broader picture along that tenor. But the 1 year, obviously shorter term, and pretty much sitting around the 4 3/4 mark. So the Fed are expected to get rates to a minimum of 5%. So I don't know, 25 pips below is a bit on the weak side, if you ask me. So Feds Wallace says that's perhaps close to where, or not far as he says, from where the Fed are, but I would suggest it's maybe a little on the weak side, just looking at that 1 year yield there. He also says it's a lot easier for the Fed to cut rates if they are wrong this year. It's always easier to cut than it is to hike, and the market will love that. If inflation pops back up, rate hikes will not stop. And we are talking about maybe 75 pips more of rate hikes based on the last economic projections, and then a pause. He also added an interesting comment that policy lags are no longer 12 to 18 months like they once were, and now they tend to be 9 to 12 months, which I can quite agree with. We're in a world now where things happen much faster, cycles happen much quicker. There's not a huge amount of time between when the markets change their minds over different things. I think it's just the way of the world. Do you think he's right on that? That things do seem to happen more quickly than in our day still?
Absolutely. I mean, we have seen in the past, 5 years cycles that usually took over double the time. So it's all happening a lot faster. And why is that? I think it's because over the past couple of decades, the amount of intervention by central banks and governments, but mainly central banks, has been huge. So they try to control things, and they will step in to a lot faster and with a lot more force to try and alleviate some of the parts of the cycle. So basically, we cannot have a recession anymore. It's really not good. I mean, come on, it's a healthy part of an economy, and you have to accept it. I'm not saying, if things are going like 2008, of course you're going to step in and help the situation, but not with every single minor crisis happening, coming in and throwing the kitchen sink at it. So I think that's the main reason why we're seeing these cycles shorten. And so, yeah, I think that's the case.
I think it's a big part of it is also the information overload.
Yeah,
you call it technology and the advent of the internet and whatever, but there's so much more in information that we get now. Economic data points. People producing reports. Days after events. Jobs markets and that sort of thing. And I think you're right. I think it's forcing central banks to micromanage monetary policy much more.
Yeah.
Rather than sitting back and saying, right, we've hiked now and we're not going to do anything for 3 months and then see what happens then. They're forced to react to all this information because the markets react to this information. And they reprice expectations, which then transmits or doesn't transmit policy through. So I think it's all becoming a bit micromanaged.
And isn't it incredible that the Fed are already starting to mention rate cuts? I know it's only if we start really going back towards target and maybe below and this and that, but they're already. I mean, I know inflation is dropping pretty fast, but we're still at 6.5%. So if I was the Fed, I wouldn't even be mentioning it now. Of course, if inflation drops and goes below and things look bad, of course they're gonna cut. But why mention it now? I don't get that. It's almost as if they're trying to prepare the ground, and make sure people don't forget that they can cut as well.
No, you're right. And I remember an instance. I think it was Carney. when Carney was on board, and the market was trying to push him to talk about cuts. And I remember, I think for at least 2 appearances, he would not even mention the word cut. He would answer a question on it, but he wouldn't actually say the word cut. And he was watching him, he was very forceful that he didn't mention the word cut. He would say, we're not maybe looking to do what you're saying we're doing, but he didn't mention the word cut at all, because they didn't want that language being associated in any way, shape or form. And the fact, like you say, that some are even using that language in whatever terms, as you say, might be a little bit of a preparation for what they're going to do moving forward.
Yeah, and it's not like they said something groundbreaking. It's perfectly logical. If things go bad, you're going to be cutting, of course. But why go there now? I don't get it. But anyway, they are the PhDs and the smart guys. I'm clearly the idiot.
They're their own worst enemy sometimes. So but that's going to all play out in this FOMC. I think again, I'm going to be watching if there's a strong pushback against these easing of financial conditions, or if they're happy to let them slide. And if they're happy to let them slide, I can see the dollar having some further damage, and the same thing for yields. But a lot of water to go under the bridge until that next week. Now, speaking of flows and stuff, Bank of America weekly report showed that 12.7 billion flows into emerging market debt and equity funds in the week to last Wednesday was the biggest ever inflows for those, and it was all due to the China reopening stuff. So big flows going into emerging markets there. Obviously, that's going to have an effect, as we've seen on currencies, with those sort of currencies gaining as the big money washing machine sloshes around, moving funds hither and thither. A Bloomberg survey, I think it was a Bloomberg survey, said nearly 20% of US firms expect to reduce their headcount, according to survey. So nearly 20%, which, is not nearly 50%. It's not over 50%. So, they try and make it sound like it's a big headline, but you look at it in numbers terms, and not quite 20% expected to cut jobs doesn't suggest we're going to get a collapsing jobs market anytime soon. Touch wood, obviously we'll probably see a crappy NFP now, I've said that. But anyway, in my opinion, we're not seeing yet big jobs downside moves. We have seen, some of the tech firms cutting labor, Amazon, Google, Microsoft. But if you actually look at their numbers, it's not actually big. It might be a big headline. So, for example, let's look at Microsoft. Let's look at Amazon. I think what they cut in 15,000 or something. I don't know if you remember.
As a percentage of the sales of the labor force, it's very small. But still, it's you fire 15,000 people, it's 15,000 people.
I get it. But I looked it up. Amazon employ 1.5 million people, over 1.5 million people. So cutting 18,000 it's a drop in the ocean. So even if you take the likes of Amazon, Microsoft, Google, Facebook, Twitter, and all that, I don't even think it's 200,000 all in those numbers. That's one NFP, if you like. So it may make big headlines, but you have to look at the context. How does that affect the jobs market as a whole? And a lot of these companies have been gaining workforces, 10, 20, 15% over the last couple of years. So, you're going to see some job losses. But if Amazon were announcing 200,000 job losses and Microsoft 50, 60,000, then we're talking something different. But it is largely all consigned, it seems, to this tech sector at the moment. Rather than other big layoffs, manufacturing and that sort of thing. So still, the jobs market is looking pretty good.
And we saw jobless claims Friday, very good number. So it's still, it is a lagging indicator, but employment, but still it's the one part of the US economy which is still doing good.
Yeah, exactly. And we perhaps need to be careful with that jobless claims because it did cover sort of the second week of the year, and it can be a bit of a funny time for these weekly numbers. So we need to see whether that trend is going to continue or we're going to see it going sideways as we have had before. Right, let's take a butcher's at some of the prices then, because we have had some moves. Dollar yen was a bit funky overnight, sailing up nice and pretty into 130 as we closed the week off. Then we saw a bit of a sag, got all the way down to pretty much 129 before bouncing again back up to 130, and now we're seeing it off again. To me, this looks like we don't know where we're going. It's a bit of a pause, finding a bit of balance. We've had this solid support. We've spoken about it, where I expect the range to be. Maybe somewhere from these 127s to 134s. So for me, all this messing around in the middle is just popcorn watching for me. Our next main area above is up in the 131s. So I'm going to look to see if we get a move up there. I did cut out some of my short up here in the 130-20s, just because I thought we might be getting this sort of bounce and this sort of movement, and I didn't want to have too much as it rallied up. So put some in the bank, keep some on in the pot, but just at a reduced position. See if we get a move higher, which I can then start adding back into shorts. But for me, the price action here is very much undecided. We're not really testing the lows again. We're not moving up to the highs. So I expect this to go wandering around for the foreseeable future, particularly into the FOMC next week. We may not see the market strain too far. I've also had another, for those of you who are subscribers to the ForexAnalytix platform, know I do the options roundup or summary at the beginning of the week, just looking at the week ahead. And option volumes still remain very low, particularly in dollar yen. So it's really a sign of Japanese firms who previously weren't hedging their positions, maybe, but overall activity is down. So although we've had big moves, there's not a lot of option players looking to taking advantage or trying to position for any further big moves. That may change over the weeks ahead, but that adds to the lack of activity also that we may see at times in dollar yen. Volatility has been high. We need to keep an eye and see if that drops back. So for me, dollar yen a bit neutral at the moment. I should call it that. Euro dollar looking like we might get a little bit of a break. There's a little bit of a thumbprint for you there. So looking at that, we do seem to have this break out the zone, the 108.70-80s area. We've had a break of 109. It's rallied up a bit, but then it's petered out. And now, again, it's not looking convincing. And that's one thing I'm looking at with these breaks. We're not looking convincing in some of these breaks. It looks convincing in this part, but I want it convincingly broken above that longer term trend line, above the fib. I want to see nice solid support coming in there, because if it doesn't, it just makes it look a bit messy. I am going to keep an eye on this 70-80 area down here. If we get a test and hold, I'm potentially then going to look at maybe putting on a bit of a long, see if we then get a move up. Overall, it needs to clear this 40 area, 109.40 area. See if I can get that back a bit, which you can just see coming in there, some prior highs in there as well. There we go, a bit of a level there around the 35.40 area, so that'll be the next level we need to knock out. But initially, to clear this zone, we need to get above that 109.40 area, and then we should be up towards 110 not long after that. Aussie dollar is another one. We're back into the 70s at the moment. But again, we've tried a couple of times and we haven't managed to last a few hours above the 70 handle. So we need to get above there. Again, I want to see a break above the 70, 25, 30 area. And then that prior resistance that I've had up at 70.65, which showed up on that first break. That still remains the next level to take. And then we get into these big fibs up towards 70, 90, 71. So lots of big levels coming up again for Aussie dollar to chew through. But it's doing all right. It's getting support where it needs to get support. I didn't add to my longs last week when we got a test of 68 70s. I am still a bit long from 74 from when we were down here last time. So I didn't add back in. I'm going to see how this price action plays out, because if we start to bump our heads again on the old resistance, I'm going to maybe take a bit off my long held longs again, just to put some in the bank and keep going. $1 is an interesting one as well. We still cracking our head up on this 679 area, but I've got some buy stops in, and I'm going to keep them in, because I think if we do get a break above, it's going to go. We are obviously in the midst of Chinese New Year, so activity is a bit lacking perhaps this week. Again, the options market has virtually nothing rolling off this week, and usually there'd be a few billions here and there rolling off, but I think the biggest is about 400,000 this week, 400 million this week. So nothing much going on there.
400,000.
400,000, yeah, not worth getting out of bed for that. But yeah, I'm in with some buy stops. If we can finally crack this area, then maybe we get a move up to that prior level 684. Maybe we move back up towards the 90s. But it's not straying too far. So while it's banging its head, it's not dipping too far from it. So based on the price action, I see a break coming as a higher probability than a move back down to the lows for the moment. Still, you got anything you want to look at? Any updates on the metals? I don't know if you've got charts ready, or you can just look it off.
Well, I can show charts. Nothing really new, but yeah, I'll take it. Let me take it for a few minutes.
Yeah, no worries.
Share screen, desktop. Uno. Okay. So I will start with yields. You know me. Remember, we were talking about this confluence of supports in 10-year, and it's bounced really nicely. It's gone already 15 base points, I think. And I've been talking about the targets. I think somewhere between 361, 368. This area here, I think, is the first realistic target, which is not that far. And then if that gets breached, and that coincides with the 50 DMA as well, I think we're going for these highs around 390. The move has started, but obviously, with if the dollar starts weakening, then that's going to find some resistance for sure. Now, currency-wise, excuse me, the euro is the one that's really moving again. And we were talking about this with Michael Brown, remember, on last week, about the divergence of the two central banks. And unfortunately, I was looking for a dip to get long. I didn't get it, but we are rising. What was your target? What was the level you were talking about? I see 109, 40 something.
Actually, that fib, yeah, you got that fib there, 42, yeah.
Yeah, so that around that level there is, I think, is doable. Then it's going to depend on the Fed, and let's remember it's 9 days away, so not that far now. And I think the market's pricing fully at 25. I looked at Fed fund futures, and I think the spread between the current one in February, because it's on the 1st of February, was 24.5 based on 25. So basically 25 is priced in. And I don't think the Fed will do anything different. I mean, they have no reason to surprise the markets either with a 50 or a nothing. So 25 is baked in. What do they do next is the big question. I think the chances are they're going to do 25, maybe one more. But as I've said before, I think inflation in the US is going to be dropping quickly. It's already dropping. It's down to 6.5% from almost 9. Was it 9? Whatever it was. Remember, they've changed the way the inflation is calculated. They did that starting this month. The BLS kind of announced it on the side, didn't make too much noise about it. And the calculation difference is now they are not going to take a 2-year range to calculate the inflation rate. They're going to take a 1-year range. And well, let's think about it. What was 2 years before? The inflation was very low. The past year has not been very low. So any change now in inflation is going to be compared to a much higher value than before. What does that mean? You're going to get a lower inflation print. So, and this could be huge. I mean, we had 6.5% year on year last month. I wouldn't be surprised if it drops by more than a base point, more than 1 full percentage point the next print. It could go a little bit crazy. So we have to be aware of that. That's why I think 25 is done for next week. But after that, all bets are off. Because you can bet if the Fed see inflation dropping quickly, by a percentage point or more, they're going to get very happy about that. They're going to blow their own trumpet, obviously, and say, we did this. And they're going to get quite defensive. So just something to think about. Euro pound, we're talking about this on Friday. I was looking for a drop towards this 50 DMA 87.2. Didn't get it. I think, you know me, I had the small core long, which I took out at 88.40. Was it 38.40, something like that? And I was looking for a drop to that 50 DMA just to get another position on and ride it towards 90. I think 90 is the target still. And with the ECB being hawkish, or at least more hawkish, a lot more hawkish than the Bank of England, I think we're moving in that direction. But I did miss this trade, unfortunately, but it's okay. Win some, lose some. Metals, gold still consolidating around this, consolidating, not quite, it's a pretty steep rise it's been having over the past, month or so, month and a half, too. And if you look at this chart, this is definitely not bearish in any way. Yes, momentum is stalling a little bit, but you have corrections when you have a strong move. This is definitely an impulsive move higher from 16.15. What was that low? Wow, this was in November. I mean, it's gone far, right? Within actually this fib now, this can go no longer valid. So in 2 months, basically, we've gone from 16.15 to 19.25. That's a big move. And
I was long off that low, if you remember, because that was a big fib level on the way down. I can't remember where it was.
Yeah, you're right. Actually, you're right.
Yeah, it was a 50 fib of the August 2018.
There you go.
14. So it was a big old fib one, but not even I expected to go rallying that high. And I was going to ask a question. How much influence do you put on the Chinese New Year? Because gold can get a good bid on into the Chinese New Year because it's obviously used for gifts.
Yes.
Hard gold. Would you be surprised if we saw it pull back a bit? Once New Year's over?
Not really. I mean, this is seasonality that we see very often. I mean, January is always a good month for metals in general. And the Chinese New Year is a big factor, I think, of that. So after this, yes, I mean, we could have a pullback. I wouldn't be surprised at all. And actually, I think it could be. I still think it's the most probable scenario. So if let's go. Hold on, let me go on a daily. And so if this was the top, let's see. So yeah, 38.2 at 18.14, so $100. Remember, I said this last week again. Can we go down $100? Of course we can, and it would be a very nice and reasonable pullback before another push higher. And as inflation goes lower, and as the central banks turn more dovish, and as long as the world is not ending, this is good news for metals. It's pretty clear for me. So any drop towards this 18.15, 18.14, 18.15, maybe even a little bit higher. These things are not exact. As you get close to important levels, you see anticipation, people anticipating it. So maybe sometimes it just doesn't get there. I'm definitely going to be getting a little long down here. But yeah, so that's my view on gold. Silver is the same as before, 24.50 or 22.20. And we're right in the middle. And I still wait. I still have my half position long, and which is doing nicely. But I want to add. Where do I add? Well, obviously you want to add at lower levels because I still believe that the next move is going to be quite a bit higher. But if we go above 24.50, I'm happy to add there. Platinum is also another one I look at, and this was not exactly, this trend line maybe is not perfect, but it tried to break out, a little false breakout. It's come back down, testing the 50 DMA. Also, it's also a fib there. We're kind of in no man's land, waiting for the Fed next week. So I'm not in a hurry to make any moves on this stuff. The S&P again, the same. This is something I drew a little while ago. The upside for me, look, it was tested here. It's about 4,000. The upside is quite limited compared to the downside. If you have a bearish bias, then selling up to this resistance here is not a bad risk reward trade. Now, having said that, you have to be careful, because if this breaks, most likely it's going to mean that the Fed is dovish next week, which means you really don't want to get ahead of this in its way. So if this breaks and the Fed is not hawkish, then I think 41.50 is the next level, a very clear level, and it's 150 points on the S&P. Yeah, we could all use that if we can get it. So we are kind of on edge or in no man's land in quite a few instruments. I think the Fed once again will give clarity, but for me, the most important reading now is the next month CPI, because of the calculation change, because I was always saying that it's going to start dropping quite quickly, and it has been, right? It's been dropping by over 0.5 percentage point per month for the past few months, and the trend is still there. So let's see what effect this calculation change has. I think we could see a big surprise. So we have to be careful. And finally, cryptos. Yeah, they're breaking out from the previous kind of, it was in hindsight, it was a bottoming formation here, but still, if you look at the big picture, this is still a one massive sideways consolidation after the impulsive move from 68K, 69K down to 18. Jesus, that was a big move. Wow. Yeah, so good news for cryptos. Definitely, if the Fed gets more dovish, if the markets think that easy money is coming, you can bet there's going to be more crypto inflows. And you see Mia Khalifa started her own crypto exchange. You see that? Yeah, if my wife asks, I don't know who she is, but but yeah, every time, whenever there's optimism and this and that, you see things like that happening. I still feel that cryptos have one final washout lower, unless we get a big turnaround from the Fed, which is actually not an unreasonable scenario, and I think it's quite possible. So yeah. Anyway, so that's for me. I mean, nothing really new for people who watch every day, but just an update on how I'm seeing things.
Yeah, cool, mate. Thank you very much. Gets us set up for the week ahead. And speaking of the week ahead, we'll have a quick look at the data. Charlie, I've seen your question. I'll come to that in a moment. So let's have a look at what we've got coming up. One of my favorite data points, Eurozone consumer confidence, the flash number today. It's one of my favorite because it's only ever been positive about 4 times in its entire history. So shows that the Eurozone consumers are a miserable bunch, which you can tell from Steve normally. I say that while he's not here. He'll pick that up on the recording.
Whenever we ask a theoretical economics question on Steve, it's like, let me tell you why this is horrible. What is the worst thing ever?
I think they must just ask Steve in that survey. That's why it's been negative all these years.
Oh, man. We love that guy. But he's a bit negative sometimes.
Anyway, moving on. Yeah, and we get the flash PMIs kicking off tomorrow as well, which obviously gives us some decent data to get our teeth into. Some inflationary data from the UK, PPI coming in there. Obviously, the Bank of Canada is going to take front and centre on Wednesday. GDP data coming in for the US. That's going to be something to keep an eye on there. Although it's probably I think it's the final numbers for Q4. Or was it the beginning of Q4? I can't remember. I don't know where we are.
We have core PCE as well.
Yeah, and all right. So it's the flash numbers for the first data of Q4 for the US.
Oh, that's important.
That's going to be good ahead of the obviously the Fed in 9 days' time, wherever it is. And yeah, on Friday, PCE coming in, which, well, that's the Fed's preferred measure. The market's really making its move on the CPI data now, first and foremost, because it comes out before PCE. So this will either add to it, likely it will confirm the same sort of trend that we're seeing coming in there. US consumer sentiment there as well. I think that might be the final Michigan number as it's coming out at 3 o'clock on a Friday. And pending home sales as well, so a bit more housing data to go under the mix. So that sets us up for the week. And new home sales on Thursday, so keep an eye on that one as well. Now, Charlie asked a question. When I say always got to pick my levels, how do I go about determining a significant level? Do I look at the number of rejections, longer time frames? Okay, I always say to people when they look at levels, okay, is what you should do is scale your charts, highlight your levels, maybe highlight, 5 or 6 levels either side of where the price is at, okay? Once you've identified those levels, learn to give them a scoring, if you like. Look at the ones that might be stronger than others. So then you sort of knock out some, let's say 5 levels above. You look at those, you think, well, I like the look of that one, I like the look of that one, I like the look of that one. So you like the look of 3 levels out of those 6. So you sort of score them. And that's how you then form a trade. You think, well, I'm not going to trade that one. I don't really like the look of that level, but I like the look of that level. So I'm going to trade that level. And now you go about managing and setting out your trade, your risk, where you're going to do it. But yes, you need to go across your time frames. Very important you go across your time frames, even if you're a scalper. Because if you take the case of euro dollar, if you're looking at a short-term chart and trading the levels, fine, you're looking at, what's happening at 109 and so on and so forth. But, then you've got this trend line, which if we look at it here, is a big long-term trend line going all the way back to 2017. So that is one of those long-term levels you need to price in or factor in because it's right here in the middle of your 15-minute chart. And if you're scalping it, it's a level you need to consider. The same thing with my 108.30 70 zone. It's been a big historical zone where the price action has done something, and here we are again. It's having an effect again. It's having resistance, it's having support, it's becoming resistance. We've had this period, this week-long period where the market didn't know what it wanted to do inside this area. So if you're trading this from the short term, you need to factor that in as part of your level building, let's call it that, because here you have a level, you could sell off 108.70 and make decent pips off of it, but you've got to know what happens if it then gets back under 108.30. Fine, you may want to short against that level. You'll see from the price action, well, you can short off a 30, but you're not really getting much out of it unless you get a big rejection. So your levels are all about, as I say, scoring them. Build up the picture, go across your time frames, because a level on the daily chart, a big long historical level like this, they often show up and you can see it in the short-term price action. So you need to know what's happening here from a longer-term perspective as well as from a shorter-term perspective. The shorter-term intraday, we're looking at 108.85.90 as the support level today. For scalpers, that's important for now. For someone who trades longer term, it's not so important. Down here is more important. So it's all about your perspective and your trading. Not all levels are going to hold, but look at what's happening off this trend line. Would I trade off the trend line? No, because it's up and down, it's up and down, it's not doing anything. The same as the big figure at 109. We're up and down, we're up and down, we're up and down. It's not, nothing's clean about it. It's a bit more clean down here because we're not getting below there. So those are the levels that's showing up. It's not clean above here. We got up to a high of 25, 26. Then we got up to a high of just below 20. It's messy. But where's the next level? I've got it 109.40. Still's got a fib up there. That's the next level you look at. And as I say, you score it. So am I interested in trading this at the moment? No. So it's got a low score. But if we move up above, if we go to say 109.50 and come back down, and I see it acting as support, fine. Now it's becoming something again. So I see a lot of people, and they try and trade all the levels, and I think that's wrong. You've got to pick your levels and decide which ones are stronger. And I Bran will tell this because I tell him to do it as well. Particularly over data points. Look at the levels above, look at your levels below as we go into something like the NFP, and rate your levels. Think which ones you'd be happy to trade at, because they're the ones you assign your risk to. So yeah, it's how do you go about it, Stel? Do you have a level and it's that level or damned, or do you wait for a bit of confirmation sometimes?
It depends on how price action goes. I usually want confirmation, but it really depends on how things move. So I don't have a rule, unfortunately. I'm a much longer time frame trader, so I'm not a scalper, and scalpers usually have a very clear set of rules that they follow because they have to be quick. It's levels that you miss them, it's gone. So I do the same. I do a very similar thing like you do in terms of levels. So I have a macro thesis on certain trades, and then I go on the technicals and try to identify the levels where I want to get in and out. Mostly in. The out part you worry about later, but apart from your stop, obviously. But then I choose some levels, and then I try to think about which ones I think are the most important ones. The ones that are most likely to work. And this this comes from experience, comes from statistics. You can kind of once you start trading something often, you see what works, what pattern works better on the euro dollar rather than oil or whatever, and you try to pick and choose the ones you like. But at the end of the day, it's not for me at least, it's not an exact science. It's not rocket science either. And, I try to find 2 or 3 levels that I like and put a little bit different weighting on each one. And sometimes I will enter a different amount on each level, or, depending on where we are. So, the one I really like, I'll go, half size. The ones that I think are secondary, I go quarter size or something like that. So, but it's a lot of fine tuning, which I can't really describe. There's not a method that I have that I follow religiously. Art more than science. Yeah, David, that kind of makes sense. Yeah,
exactly. And it's really about, it's 2 things. Okay, we trade the text. The text are just colored lines on a chart, and the only reason the text work is because either everyone's watching it and everyone's trading it, so the weight of money trading it makes it become a self-fulfilling prophecy because it works, and I'll use a case of $1, or you get times where something's happening at the level because someone's got some flows or big order to do, and the price won't get past it. And every time we get up to a level, it gets hit. $1 is the perfect example. Here we have a level. I had it down as a level. It was a bit of a minor level, but we can't get above it, and we can't get above it for over the course of many days. So something is going on here. Now, when you get price action like this isn't a ton of technical traders looking at a red line on the chart. There is some force selling $1 up into these areas, whether it's to do with the new year, who knows what it is. So, this is one of the things where a level happens or it becomes defined over time. So it's like dollar yen, finding out what is dollar yen going to do between 127 and 134 at the moment. We're in a moment of, in my opinion, where we need to discover what the price wants to do. We've got some levels up and above, and some older levels that we highlighted before. Well, they're not doing an awful lot now. So maybe in a day or so or a few sessions, I take those lines out and I see what the market is going to do now. Now, yeah, everyone wants to sell it up here while it's down here. But what happens when we get up here? So for me, this is about discovery. Where are the levels going to come off? If I see suddenly 130 and a half, 130.60, we get up there 2 or 3 times and it holds. Well, now it's becoming a level. So you stick a line in for reference, and now you're building your picture. And it might not hold. It may go up to 131 and then it holds, and then we find a top down here. So there's times when things become, when things are clear. For me, it's clear down here. We've got plenty of support down here. I need to see a bit more what happens up towards here. If we get up here, hold that level, boom, you've got maybe a significant short-term double top. That enforces the range we may be in. So you know what to do up here, and then you know what to do if we come down here. And it's just building up the picture, letting the price action do its thing. Because at the end of the day, that's the best thing you can trade, price action. And I often say to new traders or less experienced traders, learn to read charts without any technical levels on it. Don't worry about head and shoulders, RSI, anything you like. Look at a chart with no technical indicators on. Learn about support and resistance. And once you get that foundation, then, most of my lines are on there just for visual purposes. I don't need this up here to tell me that this is a resistance area and a price support area. I can see that from the candle patterns. Learn the price action, then you apply your techs and move forward from there. Gavin says, yeah, you can also look at how fast a price gets to a level or not. Yeah, exactly. Let's say a swift move up here, either there's big news or something's happened and we get a move up here. If it's really quickly, you look, because that may be a stretch point. And I often say over things like data, look at your stretch point. If we get a strong NFP and the market moves 100 pips, 150 pips, where's the area where it might run into trouble and pause? And likely it'll be a level like this, or a level like 133 or 134, 34 and a half. And then you get to those levels and you think, right, well, the price has got to do something here. If this news is really good, if this NFP is really strong, it's got to break it. If it can't break it, it's only one other way it can go. And therein also lies an opportunity. So anyway,
awesome.
Great. Yeah, go on, mate.
No, I just said awesome. It's really, really good stuff.
Oh, thank you, mate. Thank you. So I hope that's answered your question, Charlie. And, we all love taking questions like that here. So keep them coming. Anytime you want to, ask about trading, psychology, how do things work and, what we do, feel free to pop that in the chat or the questions. And we're more than happy to answer it. As long as you learn from it and it improves your trading, then that's all right with us. Anyway, we shall call that a day for today for a Monday.
Indeed.
Hopefully we can set up well for the week ahead. Thank you, everyone, for coming to the Flow Show. Thank you, Stel, for
thank you, Ryan.
all your input and wonderful analysis. And thank you, guys and girls. We shall see you all bright and breezy tomorrow.
Thanks. Bye-bye.
Cheers. Hi traders, I'm Ryan Littlestone of ForexAnalytix and Forex Flow Live, and I'm here to introduce you to the Flow Show. Every day in the UK European morning session, we run the Flow Show, bring you all the latest market news, data moves and events. We make sure that you're informed about what's happening and what's to come that week and each day. What makes us different is that we bring clarity to the fundamentals. We tell you what a central bank comment or piece of data might mean for the price moves and trends you see every day. By nature, I'm a fundamental trader, so I need to know this information myself, and it's what I look at every day to shape my trading decisions. And now I want to share that with you to make it easier for you to understand them and help you learn how they can affect markets. It's not just about me listing out numbers and headlines. We analyse whether there are trends that will change or develop from certain data points, or whether a central banker said something that might change the path of monetary policy and thus prices. We don't stop at the fundamentals though. The fundamentals are just the start of my trading strategies. They create the idea for trades, but then I have to look at the charts to find the levels I'm willing to trade those ideas at. And so that's a big part of the show also. We delve into the charts to look at the tech and how they may help us either plan new trades or to manage current trades. We like to vary from the script too, and sometimes we will have a show that's purely focused on something like trading psychology. Or we may have some special guests on. You just never know who or what might pop up on the show. But that's not all. This show may have my name tag on it, but it's really not about me. It's about you. And so I want to get your input, hear your views, get your questions about all aspects of trading. If you have questions about the fundamentals, the technicals, about learning to trade better, or you simply have a question on what a particular pair asset might do, feel free to come and join the rest of the Flow Show community in asking these questions live in our chat function. So, if you're just a technical trader, we've got you covered. If you're a fundamental trader, we have you covered too. If you want to learn how to improve as a trader, well, we have that covered also. Our show brings you the information in a way that's easy for all to understand and act on. So I look forward to seeing you each and every morning on the Flow Show. Trade well and be lucky.